Hey everyone, welcome back to Corporate Decoder, the place where we dig into the nitty-gritty of corporate filings to see what's really going on. Today we're unpacking 8x8's latest move, and let's just say they're tweaking their borrowing game for a smoother ride. Before we jump in, if you like getting clear, no-nonsense insights from these dense financial reports, smash that subscribe button. And for those who want to connect with other finance fans and get more exclusive content, our Discord community link is in the description below. Alright, so 8x8's, a company you might know for its cloud-based communication services, is back in the news with a filing that touches on their debt. It's not a massive surprise a company would adjust its credit agreements, but the details here tell us a bit about their strategy. This is a current report, meaning something significant just happened. Specifically, on July 29, 2025, 8x8 signed an amendment to its existing term loan credit agreement. Think of it like renegotiating the terms of a big loan they already have. So what exactly did they change? Well, the amendment is all about making things a bit more flexible, especially when it comes to their financial health checks. They're adjusting some of the requirements they need to meet, particularly concerning permitted acquisitions. This is a pretty important point. The company is adjusting to keep its debt levels in check relative to its earnings, specifically its adjusted cash EBITDA. This ratio is a key indicator of how much debt a company is carrying compared to its operating profit. By adjusting these requirements now, they're essentially giving themselves more breathing room. This is the company saying, hey, we're not buying anyone right now, but if a good deal pops up, we want to be ready to move fast without getting bogged down by loan covenants. That's a strategic move. It shows they're thinking about future growth and want their financial structure to support that rather than hinder it. Let's rewind a bit. This current amendment is to a credit agreement they entered into last year, the 2024 credit agreement. This agreement set up a way for them to borrow up to $200 million, with most of that money needing to be repaid by August 2027. They use this to pay off an older loan. This is a big number and it paints a positive financial picture. Since their debt was highest back in August of 2022, they've chopped off a significant chunk, about $219 million, which is 40% of that peak loan amount. This includes some recent payments like $15 million earlier this year and another $10 million tied to this new amendment. So after that latest $10 million payment, the amount they still owe on this loan is down to $127 million. This shows a clear commitment to paying down debt, which is generally a good sign for investors. It suggests they're managing their cash flow effectively and prioritizing reducing their financial obligations. Now, while the filing gives us the highlights, the full detailed terms of this amendment are available. This section is essentially a legal disclaimer that says if you want all the tiny details, check out Exhibit 10.1. Like most filings, this one also includes forward-looking statements. These are basically predictions about the future. The company is telling us what they expect to happen, like the benefits of this amendment, but they're also being careful to say that these are expectations and the actual results could be different. This is the standard legalese for things might not go exactly as planned. They're flagging that risks exist and the benefits they expect from this debt amendment might not show up as planned or as quickly as they hope. It's always smart to read these carefully to understand the potential downsides. And here's a look at the exhibits, the actual documents that back up what's in the report. Exhibit 10.1 is that first amendment to the term loan credit agreement we've been talking about. Finally, we have the signatures. This is the official sign-off confirming that the company is responsible for the information provided in the report. Lawrence Denny, their chief legal officer, has signed off on this, dated August 4, 2025. Now, let's put on our investor hats and look at this. 8x8 is clearly focused on managing its debt. Reducing their loan principal by over 40% since 2022 is a significant achievement. It signals financial health and a commitment to reducing interest expenses and financial risk. The amendment itself seems to be about gaining operational flexibility for potential future growth, particularly acquisitions. This suggests a management team that is proactive and strategic, looking ahead to opportunities rather than just reacting to current conditions. Anti-reactive and strategic, looking ahead to opportunities rather than just reacting to current conditions, and a commitment to reducing interest expenses and financial risk. The amendment itself seems to be about gaining operational flexibility for potential future growth, particularly acquisitions. This suggests a management team that is proactive and strategic, looking ahead to opportunities rather than just reacting to current conditions. However, as they themselves mentioned, there's always the risk that these strategic moves don't pan out exactly as expected. The market conditions can change, or potential acquisition targets might not materialize or might not deliver the expected returns. While they're reducing debt, it's still a substantial amount, and the ongoing need for amendments suggests they might be pushing the boundaries of their financial flexibility to achieve growth. Overall, 8x8 appears to be on a path of deleveraging and strategic positioning. The management seems to be taking calculated steps to support future growth while maintaining a tighter grip on their finances. The key will be how effectively they leverage this added flexibility and whether their anticipated growth opportunities actually materialize and prove profitable. That's our deep dive into 8x8's latest filing. What are your thoughts on their strategy? Do you think these changes will pay off? Let us know in the comments below. If you found this breakdown helpful, please give it a like and subscribe for more regular corporate insights. And don't forget to join the conversation and connect with us on Discord, linked in the description. Thanks for watching, and we'll see you in the next one.